We have just seen one of the biggest changes to taxes in decades, with capital gains tax reverting to how it was originally done back in the 80s. That change means that now, instead of looking at your gain versus your cost base and then cutting it in half, we're going to compare it to the inflation adjusted cost base. And so in other words, if you bought a property for $500,000 and an inflation doubled the value of that property to $1 million, but the real value of that property is actually now 1.5, you now pay tax on only the $500,000. Whereas under the current rules, they would just say it was a $500,000 property, is now valued at 1.5, your gain is $1 million, let's cut that in half and you pay tax on $500,000. Now, I've deliberately made those numbers the same because in that situation, over the long run, it is the same. They're very, very similar. Now, there's two groups of people who are going to be impacted by this change. The first group of people is anyone who owned a property prior to the 87 changes who were not impacted by the 50% discount rule because they're being told the property has to be revalued on the 1st of July 2027 and that they have to then pay tax on gains after that period of time. Whereas under the current system, they had no tax to pay at all. There was going to be no capital gains tax to pay. So long-term investors that have owned properties before the 80s might find that they want to sell their properties before the 2027 cutoff, or they face future capital gains on that amount. But then they've got to put their money into something else. And if they put it back into property, they follow the same rules anyway. The second group of people is people like me. My investment strategy is to buy an old house on a big block, build a new house in the backyard, subdivide, and keep the new house. Now, the problem here is that because I'm going to make a capital gain very, very quickly on the old house because I've suddenly cut it in half and taken some of the land away, there's not much time for inflation to kick in. And so I'm going to pay more tax now than I would have done over the old scheme. And if I sell the new property relatively quickly, probably I wouldn't do it within 5 years, I'm still going to pay a lot more tax because my cost base is only increasing by inflation, but it was a really cheap property to buy and I don't get the 50% discount anymore, I just get the 3% increase. So I'm going to be worse off because of doing development. So basically any developer that's adding a lot of value in a short space of time is going to be made worse off by the capital gains tax changes. But ordinary investors investing for the long term, not really going to be impacted very much. Now, there's actually a third group that's going to get hit as well. And that's people that own a property and thought they were going to sell it in retirement, so therefore they don't have a regular income to add their capital gain onto. They're going to get hit because they've now got a minimum 30% to pay, whereas if it was their only source of income at retirement, they now have to pay a 30% minimum. And so that means that they don't get the $18,200 tax threshold, the next $26,800 taxed at 14%. They've got to make sure they're paying 30% in total. So there is a group that's going to get hit by this, but there's winners and losers in any budget. Our job now is to make adjustments based on the new reality and invest accordingly. Does that make sense?